Good morning, our dear subscribers. The FutureTrend channel is again with you. This morning, after a period of long weekend connected with celebrations of the Easter in the western part of the world, now the majority of market participants are back to the work, and today we'd like to focus your attention on two important themes discussing in the foreign exchange market, mostly discussing in the foreign exchange market at the moment. The first one is, of course, the continuing United States trade policy. As we know, China also imposed a higher tariffs of a row of United States goods. As we know, this row includes around 128 positions. Of course, such kind of trading relations, such kind of trading tension does not bode well for the risk-friendly currencies like Japanese yen, for example, or the currencies directly connected, for example, with Chinese economy, like the Kiwi dollar, the Aussie dollar especially. Also, the Canadian dollar is under the downside pressure because of all of these factors. Another very important theme we'd like to point your attention to pay your attention is kind of very important United States economic numbers we have during the week. And of course, it's the number one is United States payrolls report that's scheduled to be released on this Friday. What's very important? As we suggest, it's a time of a negative surprise of this kind of numbers. After a row of very kind of excellent United States jobs report, probably it's a time for a negative surprise. From this point of view, we suggest that the United States currency is ripe at the moment to resume its underlying bearish kind of mood, bearish sentiment of 2018. We suggest also that from technical point of view, the United States dollar is in position to resume its underlying downside trend. But anyway, let's discuss this step by step. First of all, as usually, we present our analysis of major currencies. And here you see that we still keep our long euro-dollar recommendation entered at 22.90 a couple of days ago. And we are ready to add some more position to this recommendation in case of let's see the graph, in case of testing the longer term uptrend line that located today around 122.30. We put a stop below the lower threshold of a currently established range of 21.50 per 25.50. From this point of view, only break below 21.50 could put the euro-dollar under increasing downside pressure. At the same time, a possible retest of the highs of 2018 located at 125.56 with a subsequent break above should mean a possible test of a longer-term downtrend in the currency, which lies today around 26.20. Here, as you can see on a weekly chart, even 26.10. So from this point of view, for those players who still keep long positions in the euro-dollar, probably the level 126, 26.20 is the level for a small pause. As regards the dollar yen, as you know, is very sensitive to the current United States trade policy. Also, as you know, the political scandal in Japan should also have a kind of pronounced effect on this currency. Anyway, a possible rebound in the stock prices, a possible a possible retreat of risk aversion sentiment should mean higher yen crosses and should mean higher dollar yen. From this point of view, probably we enter a period of kind of range trade or sentiment in the dollar yen, roughly between, let's say, 105 and 108. As you know, 107.90 is a kind of pivotal, critically important upside barrier for the dollar yen to be to keep its bearish mood. That's why we still keep our short trade recommendation. We are ready to increase our position some higher, as you can see in our report. But also we put a stop above 108.05. As regards the cable is more or less very well supported at the moment above psychological important barrier of 140. Also, from a technical perspective, the pair should trade a little bit higher while above its a shorter term kind of uptrend located at 140.20. But of course, to be much more bullish, the pair should break the highs of 2018 located at 143.45. Also, only then we can tell that probably the cable could resume its underlying bullish mood, its underlying bullish trend, and we could see much higher levels. The dollar Swiss is a little bit strange at the moment, because from one point of view, a risk aversion sentiment because of trade tensions among major trading partners like United States and China should not bode well for the Swiss franc. But the safe haven status of the Swiss franc is a little bit shaken at the moment from our point of view. As you can see, the dollar yen behaves itself absolutely different comparing to the dollar Swiss. And from this point of view, probably we should concentrate on fundamental factors and technical factors. But anyway, our underlying idea, our preferred strategy, is to be short dollar Swiss while trading below moving average 200-day line, which is located today at 96.55. That's why we will resell the pair on a possible retest of the level of 96.40 with a stop above 97. At the moment, that's all. We see you some later with our analysis regarding euro crosses. Bye bye for now.